equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to the Equity Mates Summer Series, proudly brought to you by Sharesies. Over 12 episodes, we're deep diving into some of the most exciting, interesting and well-known companies in Australia and the US. Each episode, we're also joined by an expert to help us unpack the key metrics, the bull case and the bear case for each company. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Good to be here for this summer series.
Yes, means we're on holidays. So today we are diving into Nike. And we are lucky enough to be joined by expert Bob Desmond from Claremont Capital, who pitched this stock as his high conviction idea for 2023 at the Sohn Hearts and Minds Investment Conference in November 2022. So super stoked to have him on in the second half of this episode. The summer series is proudly supported by Sharesies, and Ren, 2 reasons we love Sharesies. I'll kick off first. Invest with no minimum. You can buy shares or portions of shares on the Sharesies platform from just 1 cent. And Ren, something that you've been talking about, and that is auto invest.
That's right. It's an easy and approachable platform where you can auto invest across America, Australia, and New Zealand's market. You can dollar cost average in, you can set it up. You can do it across individual stocks and ETFs. It's like it's almost like a build your own ETF functionality where you put what you want in, allocate your percentages, say how much you want to spend, get on with your life.
Away you go. Love it. So download the Sharesies app or visit www.sharesies.com.au to learn more. And if you did want to sign up, they do have a promo code that is not exclusive to Equity Mates. It's publicly available, and Equity Mates don't get anything in return, but you do get $10 in your account if you sign up. The promo code is GROW. Promotion terms and conditions apply. So Ren, let's kick on.
Let's do it. Final disclaimer. We are licensed, but we're not aware of your personal financial circumstances. Neither's Bob when he joins us. All information on this show is for education and entertainment purposes only. Any advice is general in nature. Bryce, Nike.
Let's
go.
Let's do it. So, I mean, everyone would have heard of Nike.
Yes.
But it is a company that has come across our radar a number of times this year. So we've decided that we're going to have a bit of an exploration of it for the next 20 minutes or so before we get Bob in. But the investor relations website caught our attention.
Yes.
And this is where we want to start.
Nike is a growth company.
Yes.
In big all caps letters over a photo of Serena Williams at the top of their investor relations page.
Yeah.
You got it? It's a growth company.
Finn, move on.
Yeah, I don't know why you'd put it there, to be honest, but I don't know who they're trying to convince, their investors or themselves, but would you think of it as a growth company?
I mean, we're going to have a look at some of the numbers in a moment, and in terms of share price, you could argue that it is a growth company, but I wouldn't picture it given the size of it, given the history of it. I don't put it in the bucket of a growth company.
Yeah, well, I mean, any $150 billion company was a growth company at some stage.
Yeah.
The question is it a growth company?
Let's answer that, I think, at the end of the episode once we get through it all.
Okay. Well, I think where I was trying to go there is I think most people wouldn't think of Nike as a growth company. Yeah. They would think of it as the world's biggest apparel and sportswear maker that probably grows revenue at between 4 and 6% a year and maybe grows profit at between 5 and 8% a year.
Sounds about right.
Yeah?
Yeah.
Let's talk about the company and see if that perception's right.
All right, well, you did say it, the world's biggest sportswear and apparel brand. And if you haven't read the biography of Phil Knight, Shoe Dog, it's a must-read, in my opinion, in terms of business books. It does go through the full story of Nike, but it was founded in 1964, originally called Blue Ribbon Sports, importing shoes from Japan. And that kind of blew up in the early 70s, so they converted it to Nike in 1971. So they are celebrating their 50th anniversary this year since the conversion to Nike. And it's a pretty interesting...
that math doesn't check out, bro.
Yeah, I know, but it must have been... Yeah, I know it doesn't. He wrote a letter in 2022. Anyway, he had the swoosh still getting shoes from Japan, as I understand it, and then that contract ended in 72.
Read the
So
book.
he took it on. Anyway, read the book. The Just Do It campaign that they're so well known for kicked off in 1988. And the rest is history, Ren. They are now the world's largest.
Yeah, real marketing story with Nike. There is no finish line was one of their early taglines. Then Just Do It. The Nike swoosh, one of their most famous designs, trademarks, logos.
Absolutely.
Yeah, so I think it's a pretty incredible story. Shoe Dog is up there with one of the best business books, I'd say. You seem to bang on about Ride of a Lifetime.
Nah, Shoe Dog's better.
Really?
Yeah.
Okay.
Easy.
Wow. Easy. Wow. Get
find it
started
on our
investing
books
in
page.
Shoe Dog, the two big ones. But so, there's marketing there with the logo, marketing with the slogan, but really the Nike story is an athlete story.
Yeah, endorsements.
Yeah.
First kicked off with their major endorsement in 1984 with Michael Jordan. That is what absolutely elevated them. Because at the start of the day, they were doing athletes' shoes and they were doing running shoes and all sorts. And then the big signing was Michael Jordan in 1984 that really kicked things off. They had the Tiger endorsement in 1996 and also a Rory McIlroy endorsement in 2012, I think, to the tune of $250 million.
Why is Rory that valuable?
I don't know. Rory McIlroy, $250 million
Was he
over
young?
10 years. Tiger only got 100 over 10 years. So
Really?
Rory.
Wait, Tiger got 100 in his prime? Like pre-scandal, all of that?
Well, Tiger's endorsement kicked off in 96, so I guess inflation adjusted all those ones. It was probably worth a fair bit. But Rory came in 2012 with 250
Was he young?
million.
Was
Rory.
it like let's get the next kid sort of thing?
Well, this was only 10 years ago, and Rory's been kicking for 15 plus, so
Wow.
yeah.
Jeez.
He's absolutely nailed it. I think he's the second highest endorsed player behind Michael Jordan.
So Bryce, I got a quiz question for you.
Yeah.
Forbes have compiled a list of the world's highest paid athletes, 100 highest paid athletes.
Mm-hmm.
How many of them do you think Nike sponsor?
I'm going to say very close to all 100. 96.
You think 96 of the 100?
Well,
what do you think like Adidas and Puma and stuff are doing?
Yeah, good
Like
point. good point.
Lacoste,
Good point.
Uniqlo, like there's
Well,
other...
I looked at how many endorsements they have around the world, and they've got well over 650, I think, in 140 countries. So, good point. Maybe, I don't know, 60?
51.
51.
51 of the 100.
Wow, there you go.
Now, follow-up question. Do you want to guess who else gets a podium finish? So if Nike's number one with 51 of the top 100 athletes, according to Forbes, who's number two?
Uniqlo. The only reason I say that because they have Federer. It's got to be Adidas.
Yeah. Do you want to guess how many they have?
So there's a remaining 49 left.
Good maths.
I would say 22.
16 for
Okay.
Adidas. And then third. Do you want to guess third?
Puma.
No.
Under Armour.
Under Armour nailed it.
Under Armour.
With
8.
6.
Okay.
So you can see that it tails off. very
Tails off.
quickly. Yeah,
Yes.
yeah.
Yes. Well, the marketing budget, which we'll touch on a bit later for Nike, dwarfs those of their following companies. So-
Now, one other quiz question and then we'll move on. But I think this just really gives you an indication of how big Nike is. Not that most people need an indication. NBA, like shoes is probably where a lot of people think about Nike's dominance these days. Jordan brand, all of that. 442 NBA players. This number's from 2014, so it's a bit old, but 442 NBA players.
Mm-hmm.
How many of them do you think wear Nike shoes?
Well, I know that in 2015 they became the official uniform of the NBA. So in some way or
Different-
another, they all wear Nike
They all wear Nike clothes.
clothes.
Yeah.
How many wear shoes?
442 NBA players
wear Nike shoes.
wear Nike shoes.
It's got to be.
Keep in mind that there's like heaps of different shoe brands
Yeah,
with
yeah.
like, you know.
Yeah. I'm going to say 360.
Okay. 284.
Oh, okay.
So 64%. But
It's
again,
still pretty solid. At
dominant.
least half.
Yeah,
At least
yeah.
50%. Well, in 2022, Ren, Nike spent $1.5 billion on endorsements of these players. So significant money
wow.
going into it.
Okay.
Anyway, let's keep moving. The company today.
So about 3% of their total revenue goes to player payments. That's actually not that much.
Well, their total marketing budget, I think, is north of $4 billion.
Yeah. So about 10%. Bit less than 10% of their revenue. It's actually kind of reasonable when you think about how much coverage they have and
it's
what
crazy.
brand presence they have.
Yeah. It works for them. Anyway, well played. The company today, according to Brand Finance, it is the 49th most valuable brand in the world. I would have expected it to be a little bit higher.
Same. I would have given it top 10.
$32.3 billion is the value of Nike to the company, according to Brand Finance. And Ren, they don't just have Nike. They've got a number of brands underneath it. They acquired Hurley International in 2002, Converse in 2003, and then the Jordan brand, among others, is quite extensive. So a brand house.
I call House of Brands.
House of Brands.
I call bull on this 49. What were they? 49th most valuable.
49th, yeah.
Number 10 is Verizon.
Brand Finance?
Yeah.
Valued at what?
70 bill.
Wow.
I just like Nike is more valuable than that. You'd have to say. Costco is 40. Like Nike's more valuable than Costco. Surely.
Look,
like,
we're not-
give me some feedback.
I'm sure you could find a list.
I have the list. I'm looking.
No, I'm sure you can find a list.
The International Commercial Bank of China is number 8.
Okay.
But I mean, it's probably big in
That's
China. Huawei, number 9. I would say Nike probably more brand value than Huawei. Walmart, number 5. Like,
That's it. Well, Walmart's pretty big.
Walmart's big, but like, their brand?
Brand's big. Yeah.
This is I call bull on this.
Anyway,
Price Waterhouse Coopers.
PwC.
Oh no, they're behind Nike. Yeah. Jeez.
Anyway, let's keep going.
Let's talk about this for a bit longer. All right, let's keep going. What's next? We all know what the company is today. On some of these summer series episodes, we'll spend a little bit more time breaking down what the company is. But Nike is Nike. The question for us as investors is, where does Nike see its future? What if we were going to invest in Nike today, why would we be doing it? What's the company going to do with the money it's earning?
How does it give itself the growth tag?
Yeah, well, it just prints it on its investor relations website. I guess the question is, how does it go from 160 billion to 300 billion? I mean, it goes back in time 12 months before its share price got cut in half.
Yes.
But, well, not quite cut in half, but you get the point.
Yeah, and Ren, it's been a story that is not unfamiliar, but it's one that is starting to pay dividends for them, and that is their transition from retailers as their main distribution, third-party retailers, to direct to consumer.
Yes.
And this is where, among other things, they are starting to reap the rewards and head from that 160 bill to potentially 300 or whatever it may be.
Yes.
This is where their growth tag comes.
So,
but what do we mean by that?
Well, so traditional retail is Nike manufactures the shoes, they sell it into a Foot Locker in the US, an Athlete's Foot, or a Rebel Sports in Australia, a JD in the UK. Is that?
JDs are here as well.
Are they?
Yeah.
Fair enough. They sell it to a retailer and that gets sold to a customer. On average, and this isn't relevant to Nike, but on average, shoe manufacturer makes about 22% gross margin. That's a number that we just found. So rough, 22% gross margin. So you sell shoes for $100, Nike makes $22, and then they have to take all of their costs out, pay their staff with that $22. On average, according to Forbes, when a manufacturer goes direct to customers, so they cut out the Foot Locker or the Athlete's Foot or the Rebel Sport and they say, just come to the Nike website and buy it online. On average, the gross margin is 50%. So it means that from the $100 shoes, Nike walks away with $50, which then they pay their staff and their marketing budget. And so it's just it's a more profitable way to sell your stuff, essentially. So Nike are trying to make that transition like every other retailer. The good news for Nike is they've got such strong brand that it's going to be a lot easier for them than a lot of other companies. In the most recent quarter, Nike sold $12.5 billion worth of stuff, $12.7 billion of revenue. $5.1 billion were direct to consumer.
Well played, Nike.
So almost half.
Yeah.
Well, between a third and a half.
Yeah. Which I think has risen from 2000 and... I can't put a number on it, but that is certainly improving year on year. And we will hear a little bit more from Bob on this in the second half of this episode, because it's certainly part of his investment case for Nike. But this is a trend that we're seeing not only with Nike, but around the world with retailers as they... I don't even know. I'm pretty sure, you're going to have to fact check me. We're going to need a Googler here, but I'm pretty sure you can't buy Nike on Amazon anymore.
That's not something you need to Google. You could just go on Amazon.
True.
So let's do it live. I'm on Amazon. I've searched Nike. There's heaps of Nike stuff on Amazon. But maybe it's not directly from Nike. Maybe it's from like third-party brands. But yeah, I'm looking at pages and pages of Nike stuff.
Okay, so maybe you're right, Ren, but I definitely remember, Nike cuts ties with Amazon. Nike cuts ties with Amazon back in 2019, early 2020. So maybe it's through other distributors that are selling this on Nike. But Nike themselves have cut ties with Amazon as being a distribution outlet.
Sure.
Yeah.
So that's the first place that Nike sees its future is direct to consumer. The second place, which we're not really going to talk about, is they dabbled in the metaverse last year. Do you remember that?
Yeah.
They bought that company, Artifact.
Yes.
Yeah.
And made shoes.
Wonder what that...
How's
if
that
they've
going?
marked that investment down. And then I guess the third thing that Nike sort of sees itself, or the wave that it's trying to ride, and it has been riding for maybe a decade or so, is that shift from sportswear to fashion.
Yeah.
And, it's that athleisure trend, and I'm not fashionable, so you probably need to take this bit, but people wear Nike clothes a lot more than just exercising these days.
Yeah, so apparently last week they launched a new platform called .swoosh that gives customers a leading-edge user experience via Web3 platform. Oh. The new initiative targets brand loyalists after the company's acquisition of design studio Artifact, which specializes in creating digital artifacts and converging the latest gaming tech in making collectibles in December 2021. So it looks like they're still playing in that space, and I'm sure we can pick Bob's brains on that. But interesting to see that they're doubling down in some way. But let's turn to the numbers, Ren, because we started this episode saying that market cap of 177 billion. Do the numbers reflect a growth company? Do the revenue numbers reflect a growth company? Does the change in revenue year on year reflect? So where are we at?
So let's start with market cap, $166 billion. That's down about a third year to date. They've been sold off meaningfully in this market sell-off. Even with that sell-off, they're still up 77% in the past 5 years. And to just sort of talk about how that's happened, they were up 200% to November 2021.
Growth company numbers.
Down 50% from November 2021 to September 2022.
Growth company numbers.
And then up 30% in a month, or 2 months.
That's growth company.
So that is what it is. I guess you could say they're building a interactive Web3 platform for creators.
Paying
growth
off.
company.
Growth company.
Growth company rhetoric.
So market cap at 166 billion, revenue at 46.7 billion. 5 years ago, their revenue was 34.4 billion.
Yes. Up 36% in the past 5 years. It is remarkably consistent for a company this big. The past 5 years, this isn't compound annual growth rate. This is just year on year.
Yeah.
Up 6%, up 7.5%, down 4.4%, COVID year.
No surprise.
Up 19.1%.
as everyone went out to buy exercise gear to get back on. Could be.
True. Could be. And then up 4.9%.
Yeah, so churning out some pretty safe numbers.
Yeah, those don't strike me as growth company numbers.
No. So tickling growth company for market cap, but not quite the afterpay revenue numbers that you're seeing.
It's like any company that says they're a growth company aren't a growth company. You know, it's like any company any person that says they're cool isn't cool.
Yeah.
Any person that says they're a good driver isn't a good driver.
Yeah. Any company that says they're a growth company isn't a growth company. But what about profit?
They're profitable.
Nice.
So not like a growth company.
Yeah, true.
So $6 billion in profit. 5 years ago, $4.25 billion in profit. So up 43% in the past 5 years. You do love to see that.
So just to round it out then, Ren, it's been sold off, but they're generating pretty consistent revenue over the last 5 years, you know, averaging what feels like about 5% or thereabout 6%, and profit up 43% in the last 5 years. Numbers that you would expect to see from a company with 166 billion market cap. Feels like it's pretty safe.
Yeah. So I guess, you know, the question is, if they execute on this direct-to-consumer strategy, if they can improve their gross margin as a result, what happens to that profit number? It's growing faster than their revenue number already. 36% over the past 5 years for revenue, 43% over the past 5 years for profit. So that's good to see. The question is, if they can take that 5 billion of 12 billion of direct-to-consumer and make it 8 of 12, then that profit number should grow faster than the revenue number.
Yep.
And that's really what Bob is talking about, which we'll get to in a sec.
Yeah.
And that was really the basis of Bob's thesis at the Hearts and Minds conference. Before we get to him, the question we've been asking every time, Bryce Lesky, ethical or unethical Nike?
Oof.
Does this fit your ESG screen? The loosest ESG screen going around.
It is a pretty loose ESG screen. This Nike does fit my ESG screen.
Wow. You said it was loose.
It's very loose. That's because I'm more of a negative screener than a positive screener. And this doesn't fit in my negative screen as much as oil, weapons, major tobacco, etc.
So sweatshops are sweet.
Yeah, no, sweatshops are not sweet. And I know that, look, I know ESG has been a problem that has surrounded a number of companies that we are speaking about in the summer series. And Nike is hands down one of them. Sweatshops, fast fashion, like, you know, there's a lot surrounding Nike, but the way that I approach ESG is not quite as hardline as some other people, and I recognize it has challenges, but they are, I guess, publicly trying to address many of them. So for me, it does. What about you?
Nike is so hard.
It is, yeah.
I think a lot of people wouldn't have Nike in their screens. You mentioned some of the labor issues there. Fast fashion, there's challenges with the amount of like resource use and stuff like that, and environmental record. And then on the other side, you also have Christian groups boycotting Nike because they released those Lil Nas X shoes with the drop of blood in them. Do you remember them? There was controversy with them around the Tokyo Olympics because of the shoes that they were making. Anyway, there's heaps of stuff. There's stuff with their record in China and the NBA. Anyway,
there's been issues.
I guess my point is, whatever your political views or your views on different issues, there's probably a way that Nike's pissed you off.
Yeah.
But I also agree that Nike for me doesn't register as high as companies that are like destroying the climate.
Yeah. All right, well, let's leave it there then, Ren, and turn to a brief look on industry and some of the major competitors before we do get Bob in to hear his investment thesis. Now, Massive industry. Let's focus on the footwear and activewear. So in 2022, the global footwear market, and this was way bigger than I thought, to be honest, but $381.9 billion is the size of the global footwear market, expected to hit $500 billion by 2027. So they're going to put on an extra almost 100 odd billion in the next 5 years. Reasonable growth, 20 billion a year. And the active market, active wear market, and this surprised me even more, is $319 billion in 2022. So some massive markets that Nike is playing in. And to put it into context against some of their major competitors, you said at the top of the show, of the 100 athletes, there are sort of three players outside of Nike who are sponsoring and endorsing athletes. We said Adidas, we said Under Armour. Adidas is their closest in terms of revenue. Adidas generated 21.23 billion euros in revenue in 2021. Puma, a fair way off the pace, 7.9 billion, and then Under Armour, 5.6 billion. So Under Armour splashing a bit of cash relative to their revenue. How many did they have? Eight endorsements?
Yeah, but it could have been towards the end of the list.
True.
Yeah.
20,000 here and there.
The thing is, if you're Under Armour and you're looking at Nike and Adidas, not so much Puma, you could probably think you could take Puma.
I think so as well. Yeah. Surprising that.
The whole Adidas and Puma story is fascinating.
Yeah.
But we'll leave that for another day. Two brothers on different sides of the river. If you're Under Armour, you have to spend.
Yeah.
You have to secure that first company. And just like Jordan made Nike, Under Armour need to find their Jordan.
Yeah.
Like that's how you cut through.
Yeah.
Yeah. And then there's also a number of Chinese brands that are trying to sign up, especially NBA stars, and give them shoe deals and stuff like that. La Ning, is it La Ning?
Yeah, La Ning.
The one that we hear a little bit about, the Chinese sportswear brand. Like, we haven't got their numbers in here, but it's a competitive space. So I guess the question is, can Nike hold it?
Do Under Armour pivot and start sponsoring and endorsing video game athletes?
No. I don't think that's on brand for them.
They need someone.
You think they need someone? Here's a list of Under Armour athletes.
Okay.
Steph Curry, heard of him?
Well played.
Tom Brady, heard of him?
He's fast going out of. He's fast.
He is.
He's fast going out of fashion.
Jordan Spieth.
Okay. Yeah.
Yeah.
That's true.
Clayton Kershaw, pitcher, MLB.
Okay.
Yeah.
They've got some guys.
Cam Newton,
So-
he's not so much there anymore.
So they need to go bigger.
I think the thing is, Under Armour is still very American. Yeah. You don't really see them go global in the same way that Nike have. Yeah.
But it is a great story, great company.
Well, Bryce, I think let's put a pin in it there. Let's throw to an ad break and then let's get Bob on, because he's going to really help us understand the investment case for Nike and also the bear case. How would you sum it up?
Yeah, so I like doing this exercise where you take these massive companies that have been in existence for 50 plus years, and it's not surprising, but it's nice to unpack and understand how they face the challenge of constant innovation to keep growing, and understanding how these massive companies, you know, through management, through technology, through changing business model, try and reinvent themselves sort of decade after decade. And it's just a nice reminder that you can still get, and I'm not saying by any stretch of the imagination this is a buy, hold or sell, but you don't need to find those hidden gems when you do have some companies like this reinventing themselves.
We're going to get to the investment case. The question was, how do you sum up the company?
Reinventing itself. Okay. Sorry, I misheard the question. But
How would you sum up the company?
I would sum it up as a large company.
All right,
That's how I summarize
Nike,
it.
the biggest sportswear brand in the world, trying to cut out the middleman and sell directly to us. Let's go to Bob.
So, Ren, it is that part of the episode. We're really excited to have an expert to help us unpack the investment case for Nike. And it is our pleasure to welcome Bob Desmond, head of Claremont Global. Bob, welcome.
Thank you. Thanks for having me on.
So, Bob, we want to start with Nike as an investment, and we're really interested in this idea of what matters and what doesn't. Bryce and I have retail backgrounds. Same-store sales and sales per square meter, they're some of the metrics that retailers really watch. So when you're analysing Nike, what are some of those metrics that you're looking at quite closely?
I think the first one I'd start with Nike is you just look consistently at the organic sales growth. It's actually very few consumer products companies that have delivered what they have. So if you look over time, over the last 22 years, take COVID out of it, one down year post the financial crisis, really? Minus 2%. So consistent earnings, sales growth over time. So it's amazing, what they've delivered over time. But for us, I think that if you want to drill it down to a number, their marketing budget is $4 billion a year. So Nike is always going to outspend anyone else. And so they're probably spending about 50% more than Adidas. So we're not going to get into a bidding war. And that allows them to partner, Michael Jordan, obviously the best thing that ever happened to Nike, but Tiger Woods, Serena Williams, even in Australia we had Warney, just amazing roster of athletes. So that marketing budget is crucial from the beginning, just to really solidify that competitive advantage. And then also, I think if you look at Nike, the key thing we are looking at now is direct to consumer. How much of the business is sold directly to consumers and how much is going through third-party channel. And that's been a huge shift. And I can go into that now or we can go to later. It's up to you guys.
Let's jump into it in a second. I just want to unpack a bit of jargon. You said organic sales, and for someone with no retail background or anything like that, what does that actually translate to if you're looking at a balance sheet and I guess as opposed to non-organic sales?
So it's just sales, excluding acquisitions and currency movements. So a lot of companies can puff up their sales growth when actually they forgot the core business is actually struggling. And so the CEO says, well, core business is struggling, so let's go and do some acquisitions.
Yeah.
And then very quickly you can get into trouble because what we want are businesses that have such a great core business and the CEO is just focusing on that and making it stronger and stronger and stronger and deepening competitive advantage. And you look, over time, like Nike's return on invested capital, it's around mid-20s, and that's nearly all been organic. So this is a company that's consistently printing heaps of cash and then just keeps reinvesting. Well, who wouldn't want to reinvest back in the business when you're earning mid-20s returns on your capital?
We do want to ask about one acquisition, Artifact, but let's put a pin in that and get to what really matters here, which is the transition that Nike's making from third-party channels to direct-to-consumer. So we spoke about it briefly before the break, but give us an overview of where they are in that transition and what you're watching to see if that transition is being successful.
So, if you look back to 2015, it was around 20% direct to consumer, and the bulk of that was through their own stores. Today, we're sitting around 42%, slightly ahead of selling through their own apps and direct to consumer online and their own stores. By their estimates, by 2025, they're going to be over 60%. So the beauty for us then is now you think of those stores, with your background, you'd understand this. You go to those stores, third-party retailers who poorly designed stores, not curated very nicely, selling, you've got some guys just trying to make a sales target, selling stuff on discount, not really knowledgeable about the product. Now, if you can sell that through your own store and have beautifully curated stores, I don't know if you've been to some of the stores in London or New York. If you go to the one in London, if you're in London, go to the one on Oxford Street. It's so cool. It's like 5 floors. Every floor there's a DJ spinning decks. There's just such a buzz in the store. It was packed when I went there. The salespeople are so knowledgeable, so passionate about the brand. Rather than some sleepy wholesaler in the burbs somewhere. And then even more important now than the physical stores is the online universe. So I don't know if you're aware, but in the Nike app universe, there's over 300 million members now in that universe.
Wow. Whoa.
So if you think of the data you're getting from that, so, every day people, not me, but other people, are pulling on their running shoes and looking at that Nike logo. But not only are they doing that, now they online, sharing that information with their friends, how far have you run, all that stuff, and all boasting about how fit they are, and all that goes online. And that for Nike is incredible source of data. So now they know so much about you, and then they can say, okay, now we can, deliver you the right product, right place, right time, and they have all that data on you. So, increasingly Nike is actually becoming just as important as their digital marketing and their technology edge.
Yeah, and just before we move off from the third party to direct to consumer, give us an idea of the gross margin difference.
Yeah, it's actually a very good point. So in terms of the competitive advantage, so not only are we deepening the competitive advantage and effectively controlling the consumer and the point of sale, and the other thing as well is if you can control the distribution, much less of their goods are sold at discount, which is terrible for brands. Like you think of LVMH, they will burn stuff. They will burn stuff rather than sell at a discount because they control all their stores. So Nike, you don't get these people discounting the brand, messing up the brand. So when they sell direct to consumer, they're making twice the dollars than they do selling through a wholesaler. So you're making more money. You control the point of sale. You're getting all this data. I mean, it's an incredible story, and it's still, we're at 40% now. We think over the next 5-10 years it'll get to 60 or 70% direct.
Yeah, wow.
So I've always said if you've got a brand strong enough to sit on someone's phone, because there's only roughly, they say, 40 apps that can sit on your phone. So that's just a really good indication. Nike every athlete will have that app on their phone. They'll be tracking their running. They'll be looking at
We were joking about that for a brand like Nike, they can really go hard with direct to consumer because their brand is so strong and they're everywhere.
Exactly.
But if you're a third tier clothing retailer, you'd struggle.
New Balance is not going to make it. I don't know.
Nothing against New Balance.
Hey,
I do like their shoes.
But I'm sure Adidas and Puma and Under Armour are all pursuing similar sort of strategies and looking at what not only Nike but many retailers around the world are doing. It's not like it's a new concept that only Nike are doing. What other parts of the investment bull case, I guess, do you look at that adds to competitive advantage for Nike?
It was the first thing I said, obviously, that no one's going to outspend them in terms of creating demand. So they can spend more than anyone else. Consistency. I think the innovation is key. So Nike, because they've got such a wide range of products, they have a lot of products that they can innovate around. Like Adidas got very, very reliant on Kanye West, which hasn't worked out so well for them, and the Yeezys. Stan Smith in the past was so they're much less reliant. They really focused on a couple of key franchises. So, for example, like in the last few years, and we have owned Adidas in the past, and it didn't work. weren't there very long, and basically what we saw happening is they were lack of innovation. They were losing share. They were cutting the marketing budget. Whilst Nike, you've just got a broader range of products and better innovation. So I think that's a huge advantage. Just the stable they've got and their scale that they've got, they can innovate, and so that's a key one. And obviously the share losses and share gains. So that's crucial for us as well.
Yeah, right. Well, I guess that then brings us to the flip side, which is the bear case. So, we always like to understand if something goes wrong, what are you sort of most concerned about and the outcome of that? So if you are thinking about the bear case for Nike, what would that be?
It's all those things I just mentioned, right? So cutting marketing budgets is a terrible thing to see. Lack of innovation and new products coming through. I mean, Adidas is a bit of a mess at the moment. So interestingly, Adidas, I think the management story is quite interesting at Nike. I don't know if you know the management story. So have you read Shoe Dog?
Yeah.
Brilliant
love
book.
Shoe Dog.
Brilliant book, right? So, Phil Knight is actually still on the board. I mean, he's getting on now, but he's been there since 1968. The executive chairman, Mark Parker, he's been there since 1979. And then the CEO is a bit of a novice. He's only been there since 2000. But before that, he was running eBay, PayPal, and ServiceNow. So he's got a bit of pedigree.
Bit of a novice. He's been there 22 years.
Yeah. No. Sorry. I got 2020. Sorry.
I was going to say.
2020. Sorry. But then, interestingly, on the board, you've got Tim Cook. So Tim Cook, the CEO of Apple, he's been there since 2005. And actually, if you look at the business models, they're very similar. So if you look at Nike, the cool products, innovate, wrap it a whole heap of marketing dollars, create this hype around the product, design company, but at the back end, they outsource the production. So CapEx to sales is only 2%. So the capital intensive part, the commoditized capital intensive part, has been outsourced exactly the same as Apple does. Yeah. So I think with that management team that they've got, I think you've just got people who are just thinking longer term. So when you're looking at Adidas, Casper Rostedt came, who had a very good pedigree and came from Henkel, but his mindset was more around getting margins up, and then he started cutting marketing and more around efficiencies, I felt. Whilst Nike is more around revenue, competitive advantage, driving growth. And so those are the key things we kind of, why we prefer it over that. I mean, obviously, things that would be the bear case, losing share, cutting marketing budget, more goods sold on discount, lack of innovation. Those are all the things that would and all the things that were flagged in Adidas, and why we cut the position very quickly.
You did say a buzzword there that we were laughing about before, driving growth. The front line, the top line of Nike's investor relations website. Nike Inc. is a growth company. They want you to know it's a growth company.
I'm laser focused. I can do that one too.
We get a bit cynical, any company that says they're a growth company can't be a growth company. But
I can tell you, Nike's, if you look over, I was mentioning that sales growth, even over the last decade, I think they've been 12% per annum. Even in the last quarter, they did 10% organic sales growth. So they're going to be at that high single-digit organic growth into double digits consistently.
Yeah, it is unbelievable. And we were looking at some market forecasts, because you look at a company like Nike, it's come off about a third this year, but it's still, $160 billion market cap. And you wonder how big it can be. But the forecast for the apparel market and the footwear market they just keep growing at like meaningful sizes.
Yeah, no, it's and they've also got pricing power. So they're always taking a little bit of price as well. So you've got that. I mean, I don't think there's a consumer goods company that has delivered what they have over time. And I think if I look at Nike in 5 or 10 years, it's going to look probably like LVMH did 10 years ago. It's a different kind of, but the numbers.
Yeah.
So LVMH used to be a sort of 18% margin business, and that's where, we want Nike to get into the high teens, because you're now controlling distribution, you're now controlling pricing, you're now controlling discounting, and you're getting those EBIT dollars that you're giving away before.
It might be easier to get 18% margin with a Louis Vuitton handbag than with a Nike shirt.
They have to spend a lot of money, Louis Vuitton.
Yeah, true.
So if you look at the GMs, Louis Vuitton's is higher than Nike. I think, if I might have this wrong, but if I remember from memory, I think Louis Vuitton is in the 65 area, and I think Nike's in the high 40s.
Yeah, okay.
But then they don't have to spend in terms of dollars as much as Louis Vuitton.
Yeah,
and they're not like for like.
No,
I'm just talking about in terms of financial characteristics.
Yeah.
We want margins now 11%, but they're very depressed at the moment because we've had a huge amount of freight costs. There's probably 300 basis points of freight costs. Those are going to fall away. And then we've had discounting because there's excessive inventory in the channel because supply chains were so bad. So that's going to fall away. So their margins are probably understated by about 300 or 400 basis points at the moment as we stand.
Yeah, wow.
So those will normalize. And then every year, you've got this tailwind of probably 100 basis points in margin uplift just from the shift to direct-to-consumer.
So one thing with Nike is that they're seeing some pretty good competitors come to market. So Lululemon is an incredible story in its own right. Under Armour, quite US focused, but building a meaningful business. And over in China, we've heard a little bit about Li Ning, is it?
Mm-hmm.
Yeah.
Yep.
How do you think about those competitors? Obviously, Nike's still outspending them all when it comes to marketing and has the majority of athletes signed. But yeah, how do you think about some of those competitors coming through?
My experience with some of those brands is they blow hot and cold.
Okay.
Things come to market, they're hot for a couple of years, and then they fall away. And then you get the next hot thing for a couple of years. So it's kind of, you get those, it's a bit like in fast food, like Macca's is just the anchor in that space, and then you get various fast food brands, they come and they go. And my experience in that space over time, you're best off going with the number one. Because at the end of the day, the advantage of scale and marketing is always going to give them that anchor hold on the market. And sure, there are people that can pick off at the edges, but for them to sustain their competitive advantage, they have to be so good on their marketing, and they miss one product or one, even Adidas, good example. Them and Nike dominate that thing, but you make one slight misstep, and you can be blown off quite quickly. So. Over time, generally, you're always better off going with the number one.
Yeah.
So, Bob, before we just close out with sort of view on long-term plans, you did pitch this as part of your Sown Hearts and Minds pitch at the conference in November 2022. And That's a pitch that is designed, I guess, for a 12-month time horizon.
Yep.
Very hard thing to do.
Very hard.
May I
do
add.
not advise you.
Do not, yes. Now, it's very clear sort of the long-term investment thesis here,
Yep.
but are there any short-term catalysts that you expect to happen over the 12 months, or is it just that you're pitching this and you expect to see Nike not only this year, but over the
Yep.
next 5 perform?
So for us, everything's long-term always.
Yeah.
We always think on a 5-year basis. So it's very simple. We go, what's the business earning in 5 years? What do we think the multiple will be? And then we net present value to today.
Yeah.
And then what's the differential there? Compliance, I'm not allowed to say what it is, but the gap's big enough for us to say there's a decent margin of safety. You know, your viewers can do it their own way.
Yeah.
And we use a discount rate of 8%. And that's how we work out what we think a business is worth. And so 12 months is not kind of how we think. But I think in the next 12 months, I think you're going to see a couple of things. We know supply chains are healing. So the cost of freight is falling. So that supply chains will heal, and that will come through their numbers suddenly I think people are going to realize, you know, these are depressed. They're not going to be selling heaps of inventory on discount because everyone was double ordering. And so they've been trying to normalize those channels. So those two things will fall away. And I think they'll be taking share from Adidas. I mean, all the Adidas looks like the CEO they've got in will probably is better than the last one, I think. But they're going to have to get the act together. So I think we're going to see good organic sales growth. You're going to see the margin recovery. And then people are going to start going, hold on, these earnings are actually quite understated. Because when we look at it, we go, I think reported margin, markets estimated margin in 2023 is around 11. If you actually make some of those adjustments, it could easily be 15. So the earnings are actually quite understated. And then once you get through 5 years' time, you know, I think you'll see that competitive advantage coming through, and people will go, actually, I mean, it's the type of business you look at and you go, I can just let it compound over time. It prints heaps of cash. It's reinvesting at mid-20s. It's got long-term growth drivers. It's got terrific management. It has been cheaper, to be honest. So earlier this year, it was super cheap. I think the stock had halved from its highs. I think it's up. And it's really annoying because when we thought of doing Nike, and by the time the conference came along, the stock had moved about 15%. So that was a bit irritating. But I think a lot of the other presenters had that as well, to be fair. So that's kind of how we look at it.
Yeah, awesome. Yeah. Didn't Adidas get the ex-CEO of Puma?
Yes,
which is interesting,
correct.
just given the relationship those two companies have. It's just sharing people. Anyway.
Well, Bob, we want to say a massive thank you for taking the time. We want to close out by looking long term. We've spoken about how Nike prints cash, reinvests it. You want to see it compound over time. If management are successful, what will it compound into in 10, 20 years?
If it all works according to plan, 10 years, I'd like to see 60 or 70% sold direct to consumer, margins in the high teens up to 20%. Those are probably the two key numbers, and if that happens, then I'll be very happy.
So one thing you didn't say there was Web3 enabled community. What do you reckon about what was it? Swoosh. Dot swoosh.
Yeah,
and then Artifact, the thing that they bought last year, the NFT sneakers. Do they factor into your business case at all?
No.
Fair enough.
You're not worried about a Zuckerberg pivot?
Oh no! I think he's got his hands full with the current pivot at the moment. You mean
does Nike try and start?
Nike they've occasionally done a few things, and every time, like they bought, every time they've sort of drifted a little bit away. They just go, you know what we've got is actually way better than anything else that's out there, and they just come back to the core business. So they've sort of done a bit of pivoting, but I think if they went off and did some really big shift in strategy, we would sit back and go, whoa, what's going on there? And that would be enough for us to say, like when you saw Facebook suddenly pivot, change the name, it's like, whoa, what's going on here?
Yeah, you'd just be stoked if you were the guys that were making digital sneakers and then Nike come knocking on your door. It's like, great, you can acquire us.
So that wasn't a big part of the thesis for us, I've got to be honest.
Well, that does bring us to the end of our episode. A reminder that whilst we are licensed, everything that you heard today is general advice only, and you should seek professional advice. All information on this show is for education and entertainment purposes only. And also a massive thanks to Sharesies for supporting this episode. For more info on them, head to sharesies.com.au. But Bob, it's been an absolute pleasure. I've thoroughly enjoyed understanding a bit more about Nike, the investment case, both good and bad. So thank you so much for your time.
Thanks, Bryce. Thanks, Jen. Pleasure being on.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.